Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to talk about what we should do with our 401k or other workplace retirement accounts when we leave a job. And this can come up in a couple of, I guess three different scenarios. Of course, one is when you simply change jobs. You leave one job and you immediately take another job at a different company. Second scenario could be you leave a job, but you don't get another job right away. Maybe there's some time in between two jobs. And then the third scenario, of course, is just when you retire. And so we're going to kind of cover all three of those. So this is what we're going to do in today's video. First, I'm going to walk through the three basic options you have with a 401k or other workplace retirement account when you leave a job. That's the first thing we're going to do. And then for each of those three, we're going to kind of walk through the pros and cons of each and just some things to think about as you make a decision for your own situation. And then finally, I'm going to walk through some really important advanced strategies to think about when it comes to a 401k rollover. Now, in the video, I'm going to show you a number of different resources on the screen. And at the end, though, I'll have links to all of them below the video. And one thing I want to mention is when we're dealing with 401ks and sort of rolling them over to an IRA, for example, one of the options we'll talk about, I've done this myself many times. It is kind of a pain. And I'm actually in the middle of doing that right now with my two 401k plans that I had when I was employed at Forbes. And I'm using actually a company called Capitalize. I'll show you this on the screen. Here they are. They actually help folks roll over a 401k to an IRA, and they do it totally for free. And so I'm actually in the middle of using them right now to roll over my two 401ks. They can work with a new IRA that they can help you set up, or they can work, in my case, I already have an existing IRA that I'm going to use. They can work with an existing IRA as well. So I think a really great resource and a partner of this channel, and I'll leave a link to Capitalize below the video. All right, so let's get right to it. So again, for most of the time, you have three options when you leave a job to what you're going to do with your 401k. One option is just to leave it alone where it is. Leave it with your former employer. There are some limits depending on how much money you have in the 401k. If you just have a few $100 or a few $1,000s, your employer's plan may not allow you to leave it there, so keep that in mind. But if that's not the case, you can leave it there. And I've had 401ks, I had one at a former employer for more than 20 years. So that's option one. We'll talk about it. The second option, this is going to be very important for a lot of reasons when we get to retirement, is you can transfer the 401k to your new employer. So that's the second option we're going to look at in some detail. And then, of course, I think a very common option is to simply roll over the 401k to an IRA. So that's what we're going to talk about. So let's sort of dive in and talk about the pros and cons of each of those options, and I guess just some things to think about. And we'll start with just leaving the 401k at your current employer. There are a lot of advantages to this approach. The first one is it's simple. I love options where I don't have to do anything. And that's the option here. You just leave it there. You don't have to make any changes. That can be a great option if you like the investment choices you have in your former employer's 401k. Of course, you don't have to like all of the investment options that they have, but just the ones that you're going to use. And if you like the options that they have, that's another reason to just leave it alone. The other thing to keep in mind is you can decide down the road to roll the 401k over to an IRA or perhaps a future employer's plan. It's not as if you lose those choices if you don't make them right away. So even if you choose to leave your 401k at your current employer, you can always change your mind down the road. So that's something to keep in mind. Now, there are some, I think, disadvantages, or at least things to think about. Of course, one would be if the investment choices in your former employer's 401k, aren't that good. They're really expensive. They don't have the kinds of investments that you want. So that would be a good reason not to leave your 401k where it is. And the second thing to keep in mind is, there is some management headache. You could roll it into a 401k and you'd have, into a current employer's 401k, and you just have fewer accounts to manage. Or maybe you've got an existing rollover IRA. We'll talk about those in a minute. And you could roll it into that. Again, it would just be one less account to have to manage. The third thing to think about is that, there are exceptions to the early withdrawal 10% penalty. There are exceptions as it relates to 401ks and other workplace retirement accounts. and there are exceptions to early withdrawals for IRAs. The thing to keep in mind is those exceptions are different. They're not the same for 401ks and IRAs, and there are really fewer exceptions to that 10% penalty when it comes to a 401k. And so that might be something to consider. Let me show you a resource. This actually comes from the IRS, and again, I'll have links to all of this. But they give us a nice chart, exceptions to the 10% additional tax. And you can see the chart covers both 401ks, they're called qualified plans, as well as various types of IRAs. And two that come to mind, of course, again, you'll check this chart out, the link will be below the video, but you may have heard that there's an exception for higher education expenses to the 10% penalty rule. Well, true for IRAs, but not true for 401ks. And you may have heard of the first-time buyer exception. Here it is. Well, again, that's true for IRAs, not true for 401ks. So at least something to keep in mind depending on what you plan to do with the money. So that's option one, the pros and cons, some things to think about. Leave the money at your former employer's 401k. The second one would be transfer. You get a new job, whether it's right away or a little bit later. You have a new employer with a 401k plan. You have to check with them to make sure they allow this, but I think most, certainly in my experience, most do. You can transfer the 401k from your former employer to your current employer. And there's a couple of important advantages to that. The first is, of course, it's just consolidating accounts. I'm a big believer in having as few accounts as possible, and so it's just less to manage. So it reduces the number of accounts you have. But here's the other thing. It may give you some additional options when it comes time to retire. And there's two in particular that I have in mind. They're exceptions. They're called the still working exception and the age 55 exception. And you might be saying, what in the world are those? We'll come back to them. They're part of the advanced strategies that we'll talk about in a minute. Now, there may be some disadvantages, of course, to transferring your 401k to your new employer. The first is it does take some work. It does take some paperwork. And I mentioned Capitalize, which I'm using to do a rollover from a 401k to an IRA, but unfortunately they can't help us with a transfer from a former employer's 401k to a new 401k. So you've got to do it on your own. I've done these sorts of things before. It just takes some time and effort. So it's something to consider. And the second thing to consider and make sure before you take this approach is that you like the investment options that your current employer has in its 401k or other workplace retirement plan. The last thing you want to do is transfer from, say, a 401k with great investment options at your former employer to the 401k with your current employer that doesn't have great options. So those are things to think about when it comes time to transfer or to consider transferring from a former employer to a current employer. And then the third option, again, just a rollover to a 401k or to an IRA. I think that's probably the option that most people take. It's the option that I've taken several times in my career. And as I mentioned, I'm doing that now with Capitalize. And definitely some advantages here. The first is you have complete control over where to open the account. You choose where you want to open your IRA account. With a 401k, your employer chooses. And because you choose where to open an IRA, you can also basically have complete control over all of the investments that you want to use and the cost associated with them. You can pick low-cost index funds. You could open one at Vanguard or Fidelity or Schwab or a Betterment. I mean, the list goes on and on. So you have complete control. And again, it can help you consolidate accounts, particularly if you've changed jobs a number of times and you have all these 401k accounts out there. Consolidating them into one IRA can just make management a little bit easier. Now, with anything, are there some disadvantages? Well, again, it does take some effort. With Capitalize, it's easy. I've done it on my own in the past. It's not the end of the world, but it does take some effort. And it may limit some of your retirement, your options when it comes time to retire that are available with 401ks. I alluded to them a minute ago, the still working exception and the age 55 exception. And we're going to get to those in just a second. Now, one really important thing to consider, if you're going to roll over a 401k to an IRA, you want to make sure that it's a designated rollover IRA. A rollover IRA is different than a traditional IRA in really two kind of important ways. The first is you have more protection from creditors with a rollover IRA than you have with a traditional IRA. You know, this may or may not be important to you, but here's the basic rules, is that a qualified plan like a 401k is completely protected from creditors. A traditional IRA is protected up to a large amount. It was $1 million, and that number goes up, it gets adjusted every 3 years. The current number is $1,362,800. That's going to get adjusted, I believe, April 1 of 2022. That may be more than enough for you, but it's something to keep in mind. The thing is, a rollover IRA, it gives you protection from your creditors, just like a 401k does. There is no limit to that protection. So that's one thing to keep in mind. But there's, I think, an even more important thing to keep in mind, and that is, with a rollover IRA, you can later down the road roll that into a future employer's 401k if they allow it. You can't typically do that with a traditional IRA. So if you have a designated rollover IRA that contains just assets you've rolled over from a 401k, you can have the option down the road to transfer or roll that into a future employer's 401k. And you might say, well, that's interesting, Rob, but why in the world would I ever want to do that? Well, now we get to the age 55 exception and the still working rule. And so let's start with the age 55 exception. This is an exception to the 10% penalty tax. You may know that for traditional 401ks and IRAs, typically, unless some exception applies, if you take the money out before you're 59 and a half, in addition to any taxes you'll owe, you get hit with that 10% penalty, and no one wants to pay that. Well, there is one of the many exceptions, comes right from the IRS. In fact, I can show you the website. And again, I'll leave a link to this. Here it is. And you can see right here, it says the 10% tax will not apply if distributions before age 59 are made in any of the following circumstances. The one we're interested in is right down here. Made to a participant after separation from service if the separation occurred during or after the calendar year in which the participant reached age 55. So let me kind of translate. You're at your job, you've got a 401k, and you retire in the year you turn 55 or older. You can withdraw just from that one 401k without incurring the 10% penalty tax. That Rule 55 exception, that age 55 exception, doesn't apply to IRAs. It also doesn't apply to any 401ks you have at former employers. So one strategy, if you're going to take advantage of the age 55 exception, is to take any 401ks with former employers that you may still have, get them transferred to your current employer. And this is where the rollover IRA comes in. Maybe you rolled over a 401k years ago to a rollover IRA, and you want to include that in your current 401k to take advantage of this age 55 exception. You can roll that rollover IRA into your current employer's 401k. So you have all that money into your current 401k, and you qualify for the age 55 exception. You have to leave work. You really do have to retire. And if you do that, you can take advantage of that rule. So that's just one example of where you might want to take a rollover IRA even years later and transfer it to your current employer's 401k. So that's the age 55 exception. The other exception is the still working exception. So the idea is this: as you probably know, normally you have to take RMDs. The rule changed. It was 70 and a half. Currently it's 72. But you have to take these required minimum distributions. It's true for a 401k, it's true for an IRA, but there is an exception. And it's this: if you're still working, say when you turn 72, you can hold off on the RMDs until you actually retire. Now, there are some exceptions I should warn you about. There's some exceptions to the exception, one of which is you own the business. And it's a 5% ownership rule. So you want to make sure you do qualify for the still working exception. But if you do and you decide to work later in life, you can use it to put off the required minimum distributions. Let me just show you a quick resource. This is actually from Fidelity, and they describe it right here. You may qualify for an exception to the RMDs from your current employer-sponsored retirement account. It's important. And they give examples, 401ks and 403bs. If you're still working and there's this 5% ownership rule, you do not own more than 5% of the business you work for, and you have an employer-sponsored retirement account with the business you're working for. So that's something to keep in mind. Again, the key to remember, doesn't apply to IRAs, right? So again, if you have a rollover IRA and you decide to work past 72, you might have the option of transferring it to your current employer's 401k. And if you qualify for the still working exception, it may allow you to delay the required minimum distributions from that account. All right, two more advanced strategies before we bring the video to a close. The first is you may have a Roth 401k, and then these two exceptions apply to that. With a Roth 401k, you of course can roll it over into a Roth IRA. And the thing to keep in mind about a Roth IRA is that you have to not only turn 59 and a half, unless there's some other exceptions that apply. You not only have to turn 59 and a half before you take out earnings from a Roth IRA, but you have to have had at least one Roth IRA in existence for 5 years. It's sort of the 5-year rule. And here's the thing. If you are 59 and a half or older, but you haven't met this 5-year rule, and you take earnings out of the account, you'll actually get taxed on those earnings. You won't actually have the 10% penalty, but you will get taxed. Let me show you. This is actually from Schwab. And again, I'll link to all of these resources below, but you can see it here. You're over age 59 and a half. Withdrawals from a Roth IRA, you've had less than 5 years. If you haven't met the 5-year holding requirement, your earnings will be subject to taxes but not penalties. Now here's the deal. You only have to satisfy the 5-year rule once for one Roth IRA. And once you've satisfied it, you're good to go. And so you may think about that if you leave a job and you have a Roth 401k at that former employer, but you don't have a Roth IRA, maybe you make too much money to qualify, you may want to think about rolling that Roth 401k into a Roth IRA so that you can start that 5-year clock ticking. So something to keep in mind. Now, the last sort of advanced strategy to think about also deals with Roths, and here it is. You may know that with a traditional IRA, just like a traditional 401k, there are required minimum distribution rules. We've referred to them a moment ago. With a Roth IRA, there are no RMD rules. You're not forced to take the money out when you turn 72. However, with a Roth 401k, you are. Roth 401ks are subject to RMDs. So if you don't want to start taking money out of your Roth 401k when you turn 72, well, you can do a rollover into a Roth IRA. So a lot of things to think about. Again, I'll leave links to all of the resources below the video, and make sure you get this right. If you get some of these things wrong, it can really hurt you. I've done my best to get it right and to show you all of the resources I'm using, but keep in mind, these rules change often. They're very complicated, and even I make mistakes with them from time to time. So before you make any decisions, consult with a professional, talk to your HR administrators who run the 401k, talk to a retirement account specialist, just to make sure you get it right before you make any decisions. Hope you found this helpful. If you have any questions or comments, just leave them in the comments below the video. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.